It's always a lot more enjoyable presenting at these meetings when we've had a good run than when we haven't. I'm going to cast across various key economic and policy developments over the last 3 or 4 weeks. No discussion is complete without a balanced view. So first of all, the tariffs. The executive order was signed by President Trump as he had warned on the 1st of August, slightly worse than expected, which means that the forecast for global GDP growth will be reduced a little bit. And of course, it does increase the risk of slightly higher US inflation over the short term. In the executive order, he confirmed new tariffs for 70 different countries, ranging between 10% for the UK to 39% for Switzerland, 40% for some smaller Asian economies, the EU around 15%, China still around 40%, with the risk of that increasing again from the 12th of August, could increase by another 24%. But on the whole, pretty good. Most of the concerns around tariffs are now behind us, and there's every possibility and likelihood, in fact, that those individual rates will be reduced with ongoing negotiations. Moving to central bank monetary policy decisions, the ECB kept its policy rate unchanged on the 24th of July, and that was the first time that it didn't reduce rates in a whole year. ECB was on pause thanks to both inflation being at the 2% medium-term target and economic growth in the Eurozone. The Federal Reserve kept its policy on hold as well. On the 30th of July, we had the non-farm payroll data from the US, which was weaker than expected. And that, of course, prompted a big rally in the short-dated Treasury bond market. The 2-year yield dropped 20 basis points. It's one of the biggest daily drops in over a year, suggesting, in fact, that there is an increased likelihood of the Fed cutting interest rates at the September policy meeting. The likelihood has increased from 50% before the non-farm payroll data to 95%. In terms of inflation, yes, it does look like we'll get an increase in inflation because of the tariff effect, but just wanted to point out some very interesting data from China. Factory gate prices for consumer durables in China are now falling at around 3% year on year. So that is the steepest drop since 2009. In the short term, China's industrial glut is acting as a powerful disinflationary force across the global economy, something that global central banks will be very pleased about. Now we're going to move on to the US economic outlook. This is a report from MRB, so I will be quoting from them. Despite the recent increase in trade war risks and prospects for some slowing in growth in the second half of 2025, we continue to expect above potential US economic growth in 2026. Real growth will re-accelerate above 2% next year. The bite of this year's trade actions will diminish next year on a sequential growth basis. Monetary policy will likely be looser. The economy will receive a meaningful fiscal stimulus on top of that. The combined policy backdrop, fiscal, trade, and monetary, will be relatively more growth supportive next year. In addition, the trade-weighted US dollar has meaningfully depreciated so far this year, which will also act as economic stimulus. The net result will be that the economy will regain momentum and again grow above its potential rate next year. The caveat is that the economy still has to work through the near-term economic pain of tariffs enacted, that's to say, between now and the end of the year. Brief dislocations in the markets cannot be ruled out, even if the reasonably positive medium-term economic outlook remains intact. The economic outlook for the US done. Now we're moving on to the Eurozone economic outlook. And of course, we are quite positive on the Eurozone. We increased exposure most recently to European defense companies, and prior to that, increased the exposure to Fidelity European values, which hasn't done particularly well recently, but I think it's a coiled spring based on incredibly compelling valuations and an economy that is finally gaining momentum. So this is the report also from MRB. They continue to recommend an overweight position in Europe, and I think their report is compelling. The euro area economy is firming on the back of Germany's gradual recovery and persistent strength in the southern euro area countries. So those countries include Greece, Italy, Portugal, and Spain, and they're all growing much stronger than generally perceived and helped lift the overall region. So in aggregate, those four economies account for 29% of Eurozone GDP, which is in fact precisely the same as Germany's contribution to Eurozone GDP, also at 29%. First of all, global markets, quoting here from MRB, and they are not quite circumspect in their bullishness. Is the tail risk of a US and global recession is diminishing. The global economic outlook is improving, and there are good odds that non-US growth will be the strongest in several years. Monetary easing, pent-up demand, and fiscal stimulus in some regions should more than offset higher US tariffs. A choppy risk-on phase should persist until, and here's the caveat, 10-year developed market bond yields break out to the upside. Ultimately, sticky developed market inflation will prove problematic for asset markets, but that isn't expected for some time. I move on now to Capital Economics. Quoting from them, they feel that the S&P 500 will outperform global markets. And I quote, "The glass is increasingly looking half full to us. With the worst of the risks around trade seemingly fading, we suspect there are fewer remaining obstacles to further investor enthusiasm for AI and its implications for US companies. Of course, there's still a fair amount of remaining uncertainty, as there always is, not least around the US-China negotiations. In the middle of July, there were reports that Trump was considering firing Fed Chair Powell imminently. Of course, the markets dropped, but then reverted back again when Trump pulled back from the threat. Unlike raising tariffs, which can be withdrawn before the real damage is done, the reputational costs from firing Powell would be far harder to undo. In fact, of course, that is risk number 2. Risk number 3, fiscal stability. And here we've got a really good report from the chief economist, no less, from Capital Economics. Fiscal vulnerabilities are building across advanced economies. France looks particularly worrying. The UK and Italy also causes for concern, and of course the US as well, with the One Big Beautiful Act, which is entrenching large federal budget deficits. What's striking is not just the size of these deficits, 6 to 7% of GDP in some cases, but the fact that they're being run while the economies are operating at or near full employment. These deficits are structural and so require either tax increases eventually or spending restraint eventually to bring them down. When governments run large deficits in good times, they are storing up trouble. At some point, markets will take fright. Investors should keep one eye on the fiscal numbers and the other firmly on who's in charge. If a crisis does erupt, it's as likely to come from a change in personnel as a change in policy. Frequently asked questions. There was a survey done by Capital Economics. With all their institutional investors, in fact, they were asked to pose questions to the research committee. And of course, the most popular question, and one after the strong run in the markets, what would be the most likely trigger for a market correction? And the answer, and here Capital Economics agree with MRB, if long-term US Treasury yields, that's the 10-year, were to break through the 5% barrier that has been in place since 2022, that would probably lead to at least a temporary setback in the equity market. The second question, where do you see the dollar heading over the next 3 to 5 years? Well, even after its 10% fall this year, the greenback is still well above its long-term average in real trade-weighted terms. The dollar is also still overvalued based on most valuation metrics we track. The most likely path over a 3 to 5 year horizon is towards a weaker dollar. The Trump administration's unconventional policy approach, in particular when it comes to trade and the escalating attacks on the Fed's independence, are also key risks to the dollar. But of course, if the dollar weakens, that stimulates US growth, and it's very good for world liquidity growth and global equity markets in general. All right, so that's the end of my section. And then moving on to the local markets.
Morning, Nick. So in terms of the local update, I'm just going to give a quick update on some of the most important macro variables and themes that's played out over the last month. First off, trade tariffs. I'm sure everybody's been reading about the tariffs. Nick's also mentioned that South Africa being slapped by 30% tariffs. I suppose a big question is what are the sectors that will be mostly impacted, and also what's the impact on GDP growth for South Africa? Biggest sectors that will be impacted is agriculture and industrials. On the agricultural side, citrus farming. For you don't know, South Africa is the second biggest citrus exporter in the world after Spain. So obviously a lot of that goes to the US, and those 30% tariffs will obviously make those prices uncompetitive. And then on the motor industry, on the industrial side, there's a lot of cars and car parts being manufactured in South Africa, especially in the Eastern Cape, that get exported. So that will also be impacted significantly. From a bigger picture, the impact on the South African economy as a whole is, I would say, not that big. However, if we look at the forecast, the impact on GDP is anything between 0.2% and 0.4%. And if you look at it on a relative basis, considering that we only expected to grow by anything between 0.8% and 1% this year, it actually, at these low levels, is quite a big impact on the economy, and something that, given our sort of slow recovery, we can't really afford. They've updated their forecast for South Africa's GDP in their last meeting, and that's down from 1.2%, which you can see in the table on the right-hand side, down to 0.9%. I think a silver lining is that both the South African Reserve Bank and various other research houses still have a positive outlook for South Africa's growth. There's a lot of structural reforms happening in terms of rail, ports, electricity generation, electricity distribution, and so forth. And then moving on to inflation forecast by the South African Reserve Bank, as we discussed in the previous meeting, for 2025 is 3.2%, 4.2% for 2026, and then 4.4% for 2027. So all of those years, obviously, within the 3 to 6% target range. The latest figure for June was inflation at around 3%. That follows the April and May reading of 2.8%. So I read another report that summed it up very nicely and said South Africa's got 99 problems, but inflation ain't one of them. So it's very positive. There's been a lot said around inflation and the new inflation target, unofficial, official. However you want to see it, I'll mention more about that. On the right-hand side, it's just that graph we shared in the previous meeting that shows inflation since 2009. And you can obviously see the big spike there in 2022. And then obviously subsequent to that, inflation has come down quite significantly. The Reserve Bank announced interest rate cuts last week. They cut the interest rate or the repo rate by 25 basis points from 7.25% down to 7%. And then obviously the prime rate also came down from 10.75% down to 10.5%. What are the expectations for interest rate cuts in the short term and the medium term? If you look at forecasts from the Reserve Bank and then also the research we get, it's not expected that we'll see any further rate cuts during this year. However, in the medium term, if inflation stays at these levels or comes down in line with the new 3% inflation target from the Reserve Bank, then there's a fairly high probability that you might see another 100 basis points of rate cuts, but there's a lot of ifs around that. Just jumping to the new inflation target. So surprisingly, the Reserve Bank, the target they used for inflation in those forecasts was 3%. So why is that surprising? The Reserve Bank's got an inflation target of 3 to 6%. And they tend to focus on the midpoint of 4.5% when they adjust monetary policy or interest rates. In the previous meeting, they mentioned that they are in discussions with Treasury and they are looking at potentially lowering that inflation target down to 3%. But at the end of the day, we expected that Treasury would probably announce a new 3% target. So the Reserve Bank basically said that they now prefer the 3% target, and that it's not a new official inflation target. So it's slightly concerning because you actually want policy, which is Treasury and the budget, to be in line with monetary policy, which is controlled by the Reserve Bank. After the Reserve Bank meeting, Treasury came out, Enoch Ngugwana, which is the Minister of Finance, saying that they have not adjusted their forecast or inflation target down from 4.5% to 3%. So yeah, hopefully Treasury and the Reserve Bank will, going forward, sit around the same table and announce the official target. But just a short summary of what does it mean to have a new inflation target. In the short term or longer term, you expect to have lower inflation as the economy adjusts to this new target. In the longer term, as you have lower inflation, you'll have lower interest rates, which will obviously be fantastic for economic growth and consumers and businesses. And then obviously also lower cost of capital for South Africa. So the bonds we issue to fund our budget, that will be at a lower rate because the inflation premium that makes up a part of that yield to maturity would be lower. And then in the short term, obviously, as you've got higher interest rates, you'll have a stronger rand because of capital flow coming to South Africa. The disadvantages, obviously, higher short-term rates, and obviously that will have a impact on growth because higher rates obviously negatively impact businesses and consumers and their ability to spend. Jumping to financial markets, the JSE continues to do well. Year to date, it's up 18.1%. Yesterday, it was at 99,674 points. I see this morning it's crossed that 100,000 point mark. So yeah, the JSE keeps on marching forward. A lot of that's been driven by the mining companies, specifically platinum and gold. The gold shares had a bit of a rally the last 2 weeks with all the uncertainty regarding the tariffs, and then platinum, which was also on a tear, had a bit of a pullback over the last week. But yeah, still fairly strong markets on the local side, mainly focused on those mining companies. And then we get some nice research from a local bank. And I just thought it will be interesting to just mention to everybody in the meeting what their forecast is for the rand. We take a lot of money offshore for clients. So I think when you speak to a client, it's nice to have a sort of idea of what the base case is, or the trade weighted value of what the rand should be compared to bigger developed market currencies such as the dollar, euro, and pound.